welcome to the committee, and thank you for your service. As you know, the SEC has adopted a rule that will require all mutual funds that invest in stocks and bonds to file monthly reports detailing all of the securities in their portfolio. The compliance date for this rule is fast approaching. The fund industry expressed deep concerns during the rulemaking that the SEC was not in a position to assure that the data would be kept secure. And it emphasized that the data in the hands of a hacker could be used to trade in a way that could hurt millions of fund investors. For example, criminals might trade ahead of funds based on what they observe in the data or replicate proprietary portfolio strategies. When the SEC adopted the rule, I'm told it issued a 500-plus page release, and only 2 paragraphs of which mentioned the industry's information security concerns. In short, the SEC said that it's none of your business, we've got it covered. Obviously, that is not, in fact, the case given recent revelations, and of course I'll note that the Edgar hack did not occur on your watch. But my question, Chairman Clayton, is this. Shouldn't the SEC delay this monthly reporting of fund portfolio data until it is far more certain that the SEC will be able to keep it secure?
So that provides an example of the type of question that we are asking, which is, are we taking in data that does indeed have significant market sensitivity? And I'll take what the fund industry is saying at face value there, which is that this data, although it may be a month old, is something that would provide someone who had access to it an advantage. If somebody had a large position that they know they needed to get rid of, we can go into details. That is exactly the type of question we're asking.
Thank you.
Can we protect it? We need to know. And if we can't, do we delay our receipt? Do we have people hold it so if we really need it, we can get access to it? Those are all the kind of questions we should be asking.
Thank you. Thank you for taking that under consideration. And I also would applaud you in your written testimony and your verbal testimony talking about disclosure effectiveness and the need to reduce costs and burdens on companies. And I noted your concern about IPO activity, diminished IPO activity, and why companies are not going public. Let me share with you one example of why that may be the case, and a good example of the need to modernize and simplify disclosure requirements. And the perfect example is Section 1503 of the Dodd-Frank Act, that is the mine safety disclosure requirement. Under 1503 of Dodd-Frank, a publicly traded mine operator is required to report on a quarterly or annual basis various violations alleged by MSHA in citations and orders. When MSHA issues any of these citations or orders, it's important to recognize that the mine operator is required to disclose regardless of whether or not it agrees with MSHA's allegations. In the meantime, the mine operator has the ability to dispute MSHA's findings with informal conferencing with MSHA and formally before the Federal Mine Safety and Health Review Commission. In fact, one coal operator in Kentucky told me that over 30% or over a third of all of these MSHA violations are challenged, and many of them are successfully challenged. And that process takes time. It takes about 4 to 6 months from the date of the citation being issued before it can be assigned to an administrative law judge, and during that process, many citations and orders are modified. But by the time this occurs, a publicly traded mine operator may have already been required to include the citation or order in a quarterly or annual filing. Now, here's the problem. The problem is not only is many times these disclosures not material to the investor, they're affirmatively misleading to the investor because of the timing of when they have to file. So talking to attorneys who practice in this MSHA area and have looked at the statute, they believe that the SEC has regulatory discretion to stay the filing requirements, and I would urge the SEC to take a look at this because, of course, this can significantly undermine the public's confidence and investment in the mining industry. And I would just urge you, as you talk about why companies are not going public, this is Exhibit A. This should be the example of Exhibit A. And I'd ask for your response on whether or not the SEC would be willing to review that.
So it's not an area where I practiced, so I don't have the type of familiarity with it that you referenced. But as a more general matter, I have talked about the aggregate effects of incremental requirements, that each one on its own has a purpose, and you can see why people would ask for it. But overall, it creates quite a burden. And one of the metrics I like to ask people who run public companies is, how many days a quarter do you spend on compliance and reporting? And as a result of, our rules and the market's reaction to our rules. And I will tell you what bothers me is that it's a significant multiple of the amount of time private company managers who are good spend.
Thank you. I yield back.
Time of the gentleman.